All right. Good morning, everyone. My name is Mason Duke, and I would like to welcome you all to this class on behalf of the Economic Alliance. And today we are proud to be joined by Adam Erickson of Business Impact Northwest, who's going to be leading this training for us. Adam's been a business advisor with Business Impact Northwest since 2024, and he specializes in sales planning and market development while providing personalized coaching to entrepreneurs. He's got over 25 years of experience as a high-tech software startup veteran and has also worked as a SCORE business mentor and even owned his own restaurants. He participates in several business pitch startup competitions and works to promote entrepreneurship overall. So today he's here with us to discuss finances and financial literacy. So I will let you go ahead and take over. Go ahead, Adam.
Awesome. Thank you, Mason. Well, appreciate people joining this session. As we don't have a throng of attendance, so we can keep it fairly interactive. Obviously, the topic today is financial literacy. Just to add a little flavor to what Mason just went through. I've been a business advisor now for a couple of years. Prior to that, I helped launch 9 different software companies around the world. During that period of time, I was never the one with the great idea. I was the one they turned to and said, "How do we make money?" And so my career's been spent in the pursuit of revenue. And as with most startups, that also involved how do we get financing and funding. So as part of today's session, we're going to go through some of the ins and outs of different types of funding, what's required, how to go about estimating what we need, all of those good things to get some pennies in the bank. In my career, I've helped raise over at this stage $125 million worth of financing. Last year for my clients within Business Impact, it was over $1 million. So there's always money out there for certain businesses, certain causes, and if there's a way to get it, I've probably been there, done that, understand it. So as we go through this today, I don't want it to just be me reading from slides. If you have specific questions, I would love to be able to answer them directly as we go into it. If you could all help me out, if you could kind of put into the chat why you're kind of attending today. I'm interested to know, are you currently just trying to round out your knowledge of financial literacy, or are you actually looking to need some capital, some funds to do something? Is this just the coffee break and you're joining just for fun? Whatever it is, it would be appreciated to be understood. So with that being said, I'll quickly go into kind of an overview of Business Impact, who we are for those of you that haven't heard about us. Uh, um, we are a very interesting nonprofit organization that is been around since 1997. It's headquartered up in Seattle. I'm actually down in Portland, Oregon. Since the inception, the organization has really tried to help entrepreneurs from every walk of life get further faster. In that vein, we have 3 major components to what it is that we do. Number one, we are what's considered a community development financial institution, otherwise known as a CDFI. What that means is we are a specialized type of bank that has slightly different banking regulations that allow us to work with folks that normally would have more difficulty with traditional banking institutions to get various loans. Second, we have a host of ongoing business resources from classes, both on demand, in live, in-person classes, documentation material, all available on our website, again, to help businesses get further faster. And then third, we have business advisory services, of which I am a part of. As all of our funding is provided by federal and other private resources, most of our activities on behalf of our clients are at no charge. We do have some classes that are a couple $100 if you want to sign up and go for them, and sometimes those can be subsidized. But ultimately, we are here to fill a gap in the market for helping entrepreneurs in a lot of rural communities, a lot of underserved communities get further faster. We have 4 distinct programs. If you come to our website, businessimpactnw.org, and sign up, We have a couple different women's business centers in the areas that we serve, being Alaska, Idaho, Washington, Oregon. We do capital readiness. This is part of this section today. We have a food and farm practice as well. Uh, so it really doesn't matter as you come in. You don't have to declare I'm in this particular thing. It just helps us understand which resource that you go to. Because in addition to myself, we have other counselors and other advisors that can work on things. And then also, if you go into our lending department, it's good for us to know what it's about, et cetera. Oops. So once again, we have some starting points for businesses, the lending, the coaching, loan readiness, our on-demand courses, all of which, once again, if you just sign up, it's at no charge. You can get access to a lot of these things, which hopefully, and in the past, since 1997, have helped many businesses grow. On the lending side of the house, which we'll get into a bit further, we are a partner for the SBA, the Small Business Association. So we do carry in banking terminology, every time there's some type of loan, they call it a product. So if you hear that term being used, loan products, it just means what's available, how do you qualify for it? So SBA, we work with the Small Business Administration. We do have some loan packages ourselves that can go up to $750,000. We can go up to 1.5 million for certain properties and real estate. We'll get into, once again, the type of clientele, the collateral needed, those type of things a little bit later in this. But for the most part, if you have a financial requirement and you don't know where to go to, hit us up. I get to talk to clients every day, and they're not exactly certain of how much they need, where they need to go for, the type of financing. We're a starting point for that conversation. And if we can handle it ourselves, we're more than happy to do so because we do have a long track record in the PNW for doing that. So, getting in today's session, and once again, feel free everyone to jump in if you got immediate questions. The first thing we're going to go through is some basic terms that need to be kind of understood. So we're going to go through a definition of capital. We're going to go through what debt funding is. We're going to go through very specific terminology such as use of funds, use of proceeds, all these basic things where what we're doing here today is not rocket science. People do this 1,000 times a day in the state of Washington alone. So we're here to walk you through it. So, capital, this is always a fun question. Most of the time, when people refer to capital, they're talking about ready funds available to help grow a business. Within it, for banking terminology and business terminology, you have different sorts of capital. You have working capital, which means I need it to pay for labor. I need it to pay for inventory, etc. We have the equity capital, which means I'm accepting money in for a portion of my company. We have debt capital, which is if you take a loan from a bank, that's considered to be debt. Now, for the purposes of this call, understand when we use the term debt, that means wherever we get it from, someone expects their money back with interest on top. So whether it's a straight community bank, whether it is a credit card, debt means that someone expects their money back. When we talk about some other forms of capital, that's not necessarily the case, but the big thing is understanding that anyone who expects their money back hates risk because risk denotes that they might not get their money back. So we'll get into how we describe that. But when we talk about capital, and I say, how much capital does your business need? Normally, that means the amount of money that you require to buy things or to operate. So things to consider as we're going forward for accessing the funds. And again, understand I do this multiple times every day, every week, working with clients to define, okay, what stage is your business at? Some of my clients come to me and they have things written out on a napkin and they just want to discuss an idea. And then we start discussing, okay, in order to make that happen, how many pennies do you need in the bank? When we're going out to access capital, whether it be debt or equity, et cetera, most people want to know, well, where are you going to use this money for? So they want to have us list out kind of what are we needing the money for? This is a good initial practice to kind of figure out, do we need $5? Do we need $5 million? And then what other resources are required to go with it? Because just because you have money doesn't mean you're going to be successful. You have to know what you're using it for, how you're going to use it, why you're going to use it, et cetera. So as we go through, how do we get additional capital? The best capital ever is from profits. That again, profit is I buy something for $1, I sell it for $5, I get $4 in profit. I can use that $4 and reinvest back into the business, et cetera. On equity funding, again, I come from the technology world. Technology world, it's mainly equity funding that I want someone to invest into my company to own a portion of the company so that I get money to use. And then the value of my company grows. And then when I sell the company, whoever invested into it is going to get more money back than they invested in. Venture capital is the most highlighted term in all of this, but there's different types of equity capital. But once again, for the purposes of this call, there's really only two major sources of funding. Well, you can get grants out there and those type of things, which are not expected to be paid back. So they're not debt, they're not equity because they're not taking a portion of your business. So grants and those things, which Business Impact also works with, are non-dilutive funding, as we call it. But within equity, I'm giving someone or I'm selling someone a portion of my company. Debt, someone expects their money back. So debt, normally we're talking about financial institutions that have money and they're willing to loan it to you. But again, they hate risk. Equity is very much accustomed to risk. So differential in the ways that you look at it. Equity is not just for high-tech businesses. There's a lot of other businesses with equity. I've known consortiums that go in and buy franchises. And so you'll get 2 or 3 family members that all buy into the equity to buy a franchise, and they're all part owners of it. I've seen this with various types of farmland where people from the cities, they want part of the farm life, so they'll buy equity into a farm to say they're a part owner of it. Debt, once again, we're going out, we're saying we're going to repay this money back, so that operates under different rules within it. Also, within the debt funding thing, it's your own personal money. If you expect that to be paid back, family can put in, once again, under a term where they're going to get their money back. So there are different ways to classify that. But once again, for the purposes of this financial literacy, we have what's called non-dilutive funding, which could be a grant or crowdfunding. We have equity, meaning you're selling a portion of your business, and debt, which means it has the expectation that money is going to be paid back. Any questions on that so far? Nope. All right. So getting capital for a business, again, it's done every day across this nation by people of all walks, creeds, colors, ages, backgrounds, etc. The first thing is why do we need money? It doesn't have to be a complex reason. It could be I'm buying fertilizer. It could be I need to hire someone. It could be I need a piece of machinery. It could just be I need to get my business started and I need to buy business licenses and everything else, and that's going to cost me $5,000. Whatever it is, just write down on a piece of paper what you think you need the money for and how much money you think you need. When you work with a business advisor from Business Impact or anyone else, we'll go through it with you and just check the numbers and say, okay, do we have a source on this? A year ago, I had a client in Olympia and he wanted to buy a used tow truck. And so, as part of the lending process, he said, I think I need this much money. And so I worked with him. We went online, found a range of used tow trucks that fit his needs. And therefore, when we applied to the bank for funding, we were able to give them examples as to, hey, look, here's the type of vehicle I want. You can see the price ranges on it. But that proved that someone went through and did the research to know what we actually needed in that extent. Now, as we start building this thing up, number one, rule of thumb, it's always better to go to a debt financing entity like a bank when you have money than when you really, really need money. Again, banks hate risk. Anytime we can prove to a bank that we're at a lower risk, then our likelihood of getting funding, debt funding, is much higher. How do we prove that we're a lower risk? Well, number one, if we already have money going through our business and we're generating a profit, that makes them feel comfortable that we're going to be able to repay things. But then second, if we're asking for money, the more detailed we are in showing we know how much money we need and why we need the money, they're going to feel more comfortable that we understand what moves our business. So a business impact, 4 or 5 times a week, I walk my clients through a financial workbook and we go through these details. Again, it's not rocket science. It's just a matter of putting numbers and figures and making sure that these are rational. Because when we put a plan forward, the more detailed we're at and we know exactly what we need more or less, the more comfort we're giving to someone on the other side of the table that that money is not at as much risk as it would seem to be, especially if you're a startup business and we're estimating going forward. So we need to hang a dollar sign. It doesn't matter if it's $10,000 or $10 million. There's money out there to be had. We just need to explain how we're going to use it and how it's either going to be paid back or it's going to turn into more money at some point in time. Types of loans. Again, within the banking community, these are called products, right? So different banks, different institutions, CDFIs like business impact among them. We have classifications as to what represents a small business, what represents a commercial loan, as opposed to a lot of folks go to a home equity line. That's a HELOC, right? That's a personal line of debt. We have merchant cash advances that if, again, as Mason introed me, I once owned my own restaurant. And if I had payroll coming up and my credit cards hadn't yet been processed, I could go to my merchant bank and say, look, you take all the money that comes in on Friday. I need money today. So loan me money against that. SBA. A lot of people have heard the term SBA. Quite simply, the Small Business Administration is a part of the United States government. It, in and of itself, does not do loans. It backstops loans for other banks that want to be able to provide loans to higher risk individuals. Meaning, if I'm a bank like Business Impact and someone wants $100,000 in a loan product and they qualify for SBA backing, what that means is the SBA will come to Business Impact and say, look, Business Impact, if you do the loan by yourself, your risk is $100,000. But because we at the SBA support these type of entrepreneurs, we are going to guarantee $75,000 of that. That means Business Impact, our loan exposure is $25,000. So even if the entrepreneur defaults, we're out 25, not 100,000, because the SBA has backed that 75,000. So a lot of people, when they look, they're wondering, SBA loans, understand that various financial institutions carry SBA loan products, but all that means is that the SBA will back it so that the risk exposure for a financial institution is less. Now, the SBA has specific loans for manufacturing, specific loans for agriculture. It has a range of things, but mainly what it does is it provides a financial institution that level of comfort that we're not going to have all of our money at risk. That being said, SBA process tends to move slower. So understand that if your lender says we want to put you into an SBA product, again, it's just a loan, it's going to take more time because first we have to do our due diligence. SBA has to do their due diligence. Then it has to get questions approved, et cetera. It just takes a longer period of time. Uh, there's SBA disaster loans out there. If you get flooding going on, there are products out there for that. Basically, any type of money that you need, there's a source out there for it. But understand, the higher the risk for what you need the money, the higher the interest rate it's going to be in a debt scenario. And so I don't care if it's a payday loan, I don't care if it's an SBA loan. The higher the risk, the higher the interest. Why? Bankers hate risk. So as we go through things, and part of my role as a business advisor is to point out this is how a loan advisor is going to look at this as a risk scenario. So the more details that we have from a business plan, the more details we have for finances, the better a loan officer is going to receive that information. So every time I sit down with my clients and we're talking about we need financing, we go through this basic process. How much do you need? What do you need it for? How soon do you need it? How long are you going to need it for? How do we start building up that storyline? Because going out for financing, it's selling anything else. You're selling yourself, your enterprise, your business to somebody that has to adjudicate, is this a high risk? Is this a low risk? Does this fit what we're looking for? Yes or no? And look, I've been part of scenarios. I've been to 50 different institutions looking for money and got no, 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 no. All it takes is one. And that's part of being an entrepreneur. Unfortunately, failure is part of the game, but it's discipline. So there are different loan products for different types of enterprises. There are different sources that are for different types of people. We just have to figure out what it is that we need and where we need to go for it. But that being said, as with any financial institution, they have what they call the magical 5 C's. And if you haven't heard about these 5 C's, well, you're about to. So the first one is character. Believe it or not, when banks are about to hand out a loan, they're going to do a check on you, your business, et cetera, to see, do you have any outstanding lawsuits against you? Do you have any history of defaults, right? Do you have any complaints against you? They want to know, once again, on a risk scale, where does your character fit into the map? The capacity. If you've ever had a car loan, you know every month, or if you've ever paid rent, you know every month, payment comes due. Bank wants to know, okay, how are you going to repay this? Where is this money coming from? Again, if you're doing an apartment rental, they want to see a work history. They want to see, do you have constant income? Same thing with an automobile. If you're going to be repaying $400 a month, where are you getting that cash from? Do you have the capacity to repay? Capital. Again, the best time to go to a bank for money is when you've already got money in the bank. Bank would love nothing more to loan you $100,000, especially if you have $100,000 in cash in their bank, because they would love to say, we'll give you our money, but we're going to take your capital and apply it against that. But the more capital you have, the more capital you can have access to. So if you're thinking that you need money in 6 months from now, and right now you're flush in a bank account, now is probably a good time to go get that money from the bank because you have capital to prove it. Now comes the tricky one, collateral. Once again, banks hate risk. If you cannot repay me back the money that I loan you, what do I go grab that I can then sell to make myself whole? Most of the time when people think of collateral, like the HELOC, right? Home equity, your home is now collateral. Your car can be collateral. Your gold in a safety deposit box could be collateral. What collateral means is a financial institution wants to know, if you do not repay the loan, what can we go repossess of yours and sell it at what percent to make ourselves whole? So depending on the risk of your business, a bank may want collateral that's of equal value to the money that you're raising. So if you want $10,000, you have to provide me something that at the end of the day, I could sell for $10,000 to make myself whole. If you're of a less risk, they might say it's 50%. That's up to each financial institution to determine what the level of risk is. But aside from credit cards online, most institutions are going to require some form of collateral. Then finally, what are the conditions? If this was the old thing of, I'm sure the last buggy whip maker in the United States was doing extremely well, but whoever studied the buggy market as cars came to market were probably like, well, that's probably not a long market going forward. If you're in agriculture, banks are going to consider what are those pressures and demands on agriculture today? Do you need the labor coming in? Do you need fertilizer in today's world? All these things, they're going to take a look at conditions. Again, why do financial institutions take a look at these five C's? It is literally nothing personal. All it is they're assigning a risk factor to their money in order to present you with a proposal to say, I understand you need this money. I'm willing to lend you the money, but in order for you to get that money, here's what I need from you. Because every financial institution has internal loan conditions that they run through, and a banker can be your best friend, and they'll still deny you because when they go through their check boxes internally, that's how they maintain the safety of their capital and their money. Not too difficult, but you just need to understand going into it. Again, if you work with a business advisor such as myself, we walk through because our biggest goal is to get you the funds that you need and that you require. So the term risk and money are hand in hand. You can't get away from it. The basics, when you understand the world through the prism of a loan officer, everything is risk until you cross that risk off the board. So it's not just looking for risk, it's saying we know with any business, because we're a bank, what all the points of risk are from your past history to your conditions to how much you need, all of these things, your experience in your industry. What level of risk do you represent? This is why with a lot of my clients, I suggest, are there equity options out there? Are there friends and family that want to come into our business? Because I could spend 6 months trying to get $25,000 in a loan product from a bank. I might be able to turn around to friends and family and say, hey, do you want to own a portion of my business for $25,000? And I could get it quicker, easier, and faster because they want to be a part of an ownership group. And there are other things attached with that. But again, the speed and the risk. So equity investors are used to risk. If you own stocks in the stock market, you're an equity investor because that stock that you own tomorrow could zero out. The company could go bankrupt and you now own 100% of nothing. You're used to that sort of risk scenario from an equity position. But from a bank position, anytime we're working with a loan officer, they're going through what are those risk factors, because all they want at the end of the day is at the end of that loan of the term or the term of the loan, they have their money back plus the interest rate and all is well in the world. So when we go into a financial institution looking for a loan product, specifically within business impact, our loan officers expect us, number one, to have an initial conversation to ascertain what it is that you need, why we need it, these type of things. But then second, if you're an actual business going after a business loan, how long have you been in business? Do you have your financials? Is it a QuickBooks report out? Do you have an audited thing from your CPA? Whatever it is, we want to see that as long as the history is possible, preferably 1, 2, 3 years of operating history, so that we can find out what are the trend lines in the business. I've had certain clients that 3 years ago, their business was doing awesome. Every year, it goes less and less. So when a bank takes a look at that, the risk factor goes up because now they can say, now I see why you need the money, but your risk of needing that money goes up because you're declining as you go into it. A balance sheet. Again, this is not meant to be a course on accounting and financials to that extent. If you're not familiar with balance sheets, number one, you could always sign up for a session with me at Business Impact. Second, you could use my cheat sheet. My cheat sheet is if you ever see a term or something that you don't know, whether it's financial, business wise, technology, I go into YouTube and I just type into YouTube, okay, tell me about this balance sheet thing? So the question is, should a PL be detailed every expense? Um, Again, your PL normally lumps in expenses as to categorization. How much did you spend on automobiles? How much did you spend on travel? These type of things. When you're working with your accountant to file taxes, they might want that actual paper trail of every expense. But more importantly, from a bank's perspective, and again, as we're going for money, the bank wants to know what are we using the money for. So if it's working capital, they're going to want to see labor. They're going to want to see general forms of working capital that money goes towards. If going through your PL of the past 2 years, we see that you spend 30% of your budget on advertising, right? We're going to want to see and look and say, okay, where's that advertising spend going towards? And what are the receipts for that? Because again, the bank wants to make sure that if you're spending money, especially in the past, it wasn't going towards your vacation fund. They want to see that you're investing into the business. And by the way, it's a level of comfort for a loan officer if you show them a huge stack of receipts that are all organized and it's all represented in your spreadsheet. That gives the banker a level of comfort that you understand the tracking, the recording of expenses, and therefore you can speak to it. So, personally speaking, keep track of all of your expenses, keep them categorized. It allows us to know better how we do our cash flow, but more importantly, it provides someone on the other side of the desk comfort that we are detail oriented. The more detail oriented you are for a loan officer, the better it is. The balance sheet. If you're not just a consulting business, if you actually have assets that are depreciating or you purchase something, the current balance sheet, which is going to show do your assets equal your liabilities, and having that in place is mandatory. Tax returns. If you are a sole proprietor or you are a sole member LLC, we're going to expect to see personal tax returns because basically you're going to be guaranteeing the loan. If it's a business, an S corp, C corp, et cetera, we're going to expect to see the tax returns of the business. Again, the longer the history, the better. Again, I'm going to be the broken record on this thing. The more details we provide, the better a loan officer can adjudicate what's the level of risk on a business. What are those trend lines that they're going to go through? Because they also want to see, are you on standard with the industry? Are you doing much better than the industry? And therefore, they're going to ask you to explain how are you making donuts so much better than someone else? Are you underperforming to the industry? Then they're going to ask, is it because you don't have the capital or because you don't have the experience? So once again, this is as a business advisor, I help all my clients package this up properly so we can explain it so that we decrease the amount of time that a banker can take a look and assign risk to a particular individual, particular business. Once again, the more detail, the better. The business plan. This is something, again, it doesn't have to be overtly complex depending on the type, the size of your business. What someone's looking for is, do you know what you're doing, why you're doing, how you're doing it, where you're doing it? So a business plan basically covers what is it, why is it, how is it, where is it, when is it, who is it? That's a business plan. And the business plan then adds in the details that we're going to market with something new. We need money to spend on this. And therefore, when we do it, we're going to increase growth. It could be I need to buy or lease a new delivery truck. It could be the backgrounds of people involved with your business to show that you have competence, to show that you have background knowledge in how to operate and run the business. It will have market statistics in it. It could be you're looking for working capital to make candles to sell at a local farmer's market. Well, they're going to want to know how many people go to the farmer's market. Out of that many people, how many buy candles? What are the demographics? What percent are women? What percent are men, et cetera? So within the business plan, and by the way, today's world, you take a basic outline of something, you can throw it into an AI engine like ChatGPT, et cetera. It will build you out a business plan. But ultimately, when you engage with a business advisor like myself, I look at it as a business plan in two distinct ways. Number one, are you going to use the business plan to help you actually run and guide your business? In which case, it's setting up benchmarks for you and your management staff or whomever. But then second, is it used strictly to go out and get financing? So I've had clients before where they didn't want an internal business plan, they didn't need it, but they wanted financing, so they needed a business plan to go get that. It doesn't always sync up that the business plan becomes a tool for the business, but it can be, depending, once again, the size, the scope, what you want it to be. So the business plan just breaks it down, granular detail, and ultimately, once again, what does the financial loan officer care about? How am I going to get paid back? So we build out these financial projections and say, when we use the money, here's how our business is going to grow. And when we grow, here's the profits that we're going to generate. And Mr. Loan Officer or ma'am, you could see we're going to be able to easily repay this loan every month. In fact, we hope to prepay the loan much before the term ends so that your risk is abated and we're showing these cash flows. So the business plan, when you work with a business advisor, the core part of it when going for funding is ensuring that our projections, our assumptions are all in line, because when a loan officer looks, if there are errors in our calculations, we just increase risk, because now it shows that we didn't double check our numbers, we didn't understand something. So my role and others at Business Impact are to ensure that before we put this in front of a banker, everything checks up and therefore there are fewer questions asked. Any questions so far?
Sure, I've got one, Adam.
Yep.
So how does the picture change in terms of the business plan and the financials when you're looking at, say, a startup seeking financing versus an established business that has a few years of operations under its belt?
Well, so for most startups, again, depending on the field of endeavor, this is going to come back to the reason why most startups get equity funding, right? Because people want a part of something that's growing. Most banks, if your business is under 2 years old, they will not lend to you as a business. They'll lend to you as an individual based upon your own credit history. They won't lend to the business because of the risk factor. This is where a CDFI like Business Impact comes into it, because we say, all right, depending on the amount that you want, do you know what the field is that you're going into? In that case, the business plan is more critical because we need to show exactly what it is you're doing, why you're doing it, and how you're going to be able to generate revenue from that. Then we take a look at, okay, what is your background or your team's background going into this? If your team has a strong record of doing stuff, then again, the risk factor goes down. But when you're a new business looking for financing, either you go crowdfunding, depending on the amount that you need, you go equity and find out who wants to play in the pool, or if you're doing a bank, that's where, once again, the benefit of the benefit of the vertical stack that we have Business Impact that I appreciate as an advisor with the years that I got under my belt is a lot of times I know that we ourselves might not be the best financial partner for a certain type of loan product for a client. But that being said, when I work with my clients and we build out the business plan, the financials, I can take that to a loan officer internally and ask them, say, poke some holes. Tell me where someone else at some other bank is going to look at this and say, red flag. So we have an advantage that we have insiders that can provide us some guidance on things. And with startup companies, that's really the tricky balance as to who wants to lend in this environment. Again, I came out of the tech scene down in Silicon Valley, and one of the major financial institutions down there, Silicon Valley Bank, they were famous for knowing that their loan products were geared towards software startups. And in some cases, they actually took some equity as a form of collateral, right? So there are different ways to do it, but Mason, to answer your question in specific, it really depends on the amount that you need. What is that market you're going into, and can we assign a risk number to that sum of money, whatever it is? And then I take a look at that, or the other business advisors take a look at it and say, okay, what's the best way to go get that amount in this time frame to use in this way? But again, investing in startups is kind of the lifeblood of this country, but it's the age-old story, right? I maxed out 8 different credit cards and just to get my business running. For every glory story that you hear about that, there are trails of tears of things that didn't quite work out. But as a startup, it just again, I have a working matrix in my own head, having done this so many times, of where to go get different types and amounts of funding. Today, I have 3 calls after this with clients, and each one is looking for anywhere between 100 to 500 grand in startup capital. So again, it's not rocket science. It's just hook up with someone that's been through it before, and we just go through these type of basics on business plans, et cetera. Because then we get into again the basic business of what are all the things that we need to prepare. So on the Business Impact website, we have um, sections of on-demand courses. Again, you can just sign up on the Business Impact website. It costs no money, and you get access to all these on-demand courses that go through how do I fill out a personal financial statement? How do I fill out a financial workbook, right? All these things advisors can assist you with, but a lot of these things that a banker requires as part of when you come to me looking for money, I want you to have all these things readily available. That being said, it's not just business impact. If you have a relationship with a community bank that you've had a relationship with for a decade, go talk to one of their loan officers and say, hey, I'm thinking about doing this, or my business needs this. Tell me, can I come to you looking for that funds? And if so, what do you want? Right? I can pretty much guarantee they're going to require a lot of the same documentation as every other financial institution. But again, risk is also based upon trust. If your bank knows you and knows your family and knows everything else that you do, they're going to trust you more because you already have a relationship with them. But go have a discussion with them. But I've never been through this loan process with every client that there's not at least 2 or 3 volleys of communication of the loan officer saying, oh, by the way, provide me this most recent thing, provide me this statement, provide me this. We can try to be as prepared as possible, but part of going after financing is that interactivity with whomever you're searching capital from. But understand, equity, we're looking for upside. Debt, we're looking to prevent the downside. So the more documentation that we have, the better off we're going to be. And again, if you're expecting that I need money in 30 days, it's highly unlikely that you're going to get a business loan in 30 days from a financial institution. You might go online and do an online loan product with companies that are out there. And depending on your credit score, depending on your business profile, they might offer you a loan. Last year, I got a client who was down in Longview, an online loan for $75,000. The interest rate was 14%. Now, he got qualified within a certain period of time, and it worked out for him because he was cash flowing through it. But even today, from Business Impact, in today's environment, even if the SBA backs a loan, we're looking, if you're a startup company, we're looking at 14%. If you're an established company, we might be able to get you down to 11, 12%. If you go to other institutions, again, payday loans are usurious, right? They'll charge you 40, 50%. But all of that is just based upon that spread of interest rate is how financial institutions hedge their bet against the defaults. And so the level of risk is going to dictate. Now, you may have a personal history with your own bank, and today you go in and say, look, I'm starting this thing up, and the bank turns around and says, okay, tell you what, we'll do $100,000 at 9%. It's a 5-year loan because they know you. So this is where, again, for a business advisor, we walk through how much money do we need? How much money are we going to have to repay? How much is the interest repayment going to be on a monthly basis? And how does our cash flow from our business support that repayment? A lot of my clients today, they're looking to do leases for brick and mortar stores. Business impact, our default is get a 7-year lease and we'll do a 7-year loan because that lease has to be commensurate with the loan period. Why a 7-year loan? Because for a lot of businesses and brick and mortar establishments, we want to make sure that the cash flow coming in can do the interest payments and the principal repayments and still be a healthy business. Understand with a loan product, the more we compress the term, the higher the repayments on each and every month. And either your business can support that or it can't. And so that's what we kind of work with you through that on, depending on what it is. If, again, you're a sole member LLC or you're a sole proprietorship or you're a sole member S Corp, banks are still going to require your personal financial statement, your personal credit scores, because they know when it comes down to it, they got one person to squeeze if all of a sudden you can't repay. And how much can they squeeze out of you? And if they can't squeeze it out of you and you have to file Chapter 7 bankruptcy, no one wins. So, the lending process. I will reiterate this fact. If you're expecting money in 2 weeks, I would not. I've had clients that we have been now in the lending process for over 60 days. Number one, you have to, I won't say you have to meet, but in this case, if you're looking at the help of business impact, you meet with financial or an advisor like myself. We go through all these steps. And even today, if you want to start this process to get a loan from Business Impact, you could go online and start the process immediately without having all this stuff. It just begins the process. But we have a checklist. Again, it's on the website that you can view as the resource on all the things that are going to be required. Again, this is not just us. This is any financial institution. What occurs? So normally, if you meet with an advisor, we start compiling our business plan. Why do we need the money? How much money do we need? What are our financial projections? All those things. But in the interim, we're going to say we need to start compiling your credit score information. We need to start compiling your bank statements. We need your PL, your balance sheet, all these things so that we could submit for a loan package. Again, whether it's Business Impact or your local community bank, you go talk to the loan officer. The loan officer has a conversation with you to say, what are you doing? Why are you doing it? Because they want to hear the storyline. Then the loan officer will say, okay, here's what I'm going to need from you. Ideally, at that point in time, because we're well-prepared little entrepreneurs, we have this stack of documentation that we've already prepared. We hand it over. At what point in time, the loan officer will say, awesome, great. I now have a case file for you. I'll start reviewing the information. Now, understand, we go from entrepreneur time to banker time. So when a banker says, I'll start reviewing, well, now you're on a pile of things to be reviewed. And then as the pile gets reviewed and your file comes up, the loan officer will go through it and start checking off based on their own checklist. Do we have the right documentation? First and foremost. If anything is missing, at some point in time, they will send out a note, an email, or they might even call and say, hey, we're missing this piece of information. Can you please provide it for our file? Time. We provide it to them. They go back, they start reviewing. Then they'll probably have more questions. I've never been through this process where there are not more questions. Then we say, okay, are we filling in the gaps? What's missing? What's wrong? What do we need to explain? All of these things. And then at some point in time, the loan officer says, okay, I've got enough. I know what we need, etc. I'm now going to present this upstairs in my loan committee, these type of things. Every week or every morning, every bank is kind of different. Loan officers have a meeting and they have this schedule of here are all the loans that we are considering. And then they have to present it and say, this is what we're doing, et cetera. Do we want to play in this? Yes or no? So once that occurs, then the loan officer will either come back with more questions or they'll say, you're not approved for these particular reasons, or hey, you are approved. And now we need to really go into the process and start getting things signed off. A lot of times that means I have a client I just went through this with yesterday. She's getting a $25,000 loan for a lease on a space. And so now that she's been approved, well, now in order to actually get the funds, she has to have business impact named as a creditor and also has to have it named as a creditor on the insurance policy. So now my client has to go back, add in the insurance policy and do things in order to send it off to the loan officer. So loan officer gets everything that's needed. They submit it finally internally, and then they'll let you know when the funds will be released to your bank account, as well as the terms and conditions, everything that you need to sign saying your loan repayment will start on this date, and therefore this is what's happening. Also understand during this process, depending if you're a sole proprietor in LLC, the bank may say, you're qualified for the loan, but we need you to put in an owner contribution. An owner contribution means I need $60,000. I'm asking the bank for 50 because the bank wants me to put in 10,000 to make up that 60,000. The lender wants to know that you have your own skin in the game to try to avoid someone that just wants what we call OPM, other people's money. That, look, worst case scenario, you go bankrupt, who cares? But if your own money's involved, it's a little different scenario. But all that being said, once everything is done, the bank says money is on the way, monies get transferred, and now you have money to play with to use at will. But now you got that loan repayment schedule started. And the loan has certain covenants on it. Covenants means what's your grace period if you miss a loan payment, what occurs, what interest rates crank up, all of these things. So again, if you're working with a business advisor, we go through all those fine print details because with a bank, there's a lot of them. So within the loan process, if you're dealing with an SBA product, in case you may not have heard, the SBA has had its actual employees cut back tremendously in the past year and a half, so it's moving at a slower pace. But if we're going after a bank loan, just mark in your head 60, 90 days. And even after you get approved, ask your lender, what's the time from when I'm approved to when I'll actually receive the cash? And that's always the critical question to ask. Because if you need it in 30 days and it's not going to happen until 90 days, well, now you know where you're at. So the sooner you start this process, the better. So once again, it's a lot of common sense. And I point this out to a lot of my clients. If your friend, your relative came up to you and said, hey, Adam, I need $1,000. I would be naturally curious. Oh, what do you need $1,000 for? What are you going to do with $1,000? When am I going to get my money back? Am I going to require collateral for that $1,000? All of these basic common sense questions from a bank, it's the same thing you would ask anyone else looking to get money from you. The difference is with you're applying for a business loan, a bank expects your business to have the formalized things of profit, loss, cash flow statements, these other things, because that's the world of business, not just personal finance. If you're going to a bank and asking for a HELOC, it's pretty simple. Bank says, okay, I know you got this much equity in your house. If you default, I get this. I know that you can repay this from your current savings in the bank or whatever it is. Therefore, they feel comfortable with the risk. From a business, whenever you're receiving money in, the biggest risk is, can we repay on the terms that we need to repay on? Now, that being said, banks are not the only ones that do debt financing. There are others out there that are angel investors, and that if you guarantee them they'll get a 10% return on their money, they'll forward you a line of credit. There are ways to accomplish those things through other methods. It just depends the line of business that you're in, who's available. Uh, One of the types of financing that I've had to leverage in the past, something called factoring. Factoring is if you're selling out, let's say you produce cans of beans and you're selling out to a distributor and you give that distributor 30-day credit terms, meaning I will ship you product of $10,000 worth. You're going to pay me that in 30 days. And the distributor says, yes, I agree. I signed on the dotted line. The distributor is reputable. Well, that $10,000 I'm going to get in 30 days, I really need a portion of that today. There are companies out there called factoring companies where I take that invoice, where that distributor agrees to repay that $10,000. The factoring company will say, okay, Adam, I will give you 80 cents on the dollar. You're expecting $10,000 in 30 days. You need money today. I'll give you $8,000 today. I'll go collect on the invoice. And therefore, I, as the factoring company, I make the difference between what I pay out to you right now and what I collect in 30 days. Different factoring companies have different amounts on it. But if we need cash flow and money for cash in a short order, there are different ways to accomplish that, right? Again, preparation when we're dealing, asking anyone for money, it's always a touchy subject. The more prepared you are, the better the outcome tends to be. Why? Because it gives someone a comfort level that you know what you're doing, you know why you're doing it, you know how you're going to do it, and how am I going to benefit. If I'm a lender, I'm making money on the cash that I can loan out. If I'm an equity investor, I'm benefiting from the hope that if I invest $100 in your equity today, a year from now, it'll be worth $200. So it's all about that comfort level, and comfort is directly translated to preparation. The research, once again, working with a business advisor, anyone else, why do we need it? How are we going to use it? What other ways have been done in the past? Do I know my competition? Do I know what my market is? I tell this story often when I bought my restaurant. This restaurant was actually based in Kansas City. I was in the Midwest for a dozen years. I was working for a high-tech startup at that time, and one of our equity investors owned 10 pizza places around Kansas City. And each pizza place was generating $100,000 in free cash flow every year, meaning $100,000 in profit every year per location. So a buddy and I, we looked at that. We said, how difficult could this thing be? So we decided to buy ourselves a restaurant. That was a mind-blowing experience. I actually got an SBA loan at the time to purchase the restaurant. But going through it, all of those details that were required by the bank, I was able to secure the loan because I still had a day job, and therefore I was a personal guarantor for the loan. But one of the things I really didn't look at too closely was this place had been in business 20 years. Every time I went in, the crowd was vibrant, packed, etc. What I didn't look at was where was the exact pull from the restaurant? How far would people come to it? And what was the changing dynamics of that neighborhood called gentrification? And when I owned it for 2 years, I saw younger people moving out. And the elder population didn't have the disposable income to come in on the frequency level. Well, when we go to a lender these days, they can do research a lot easier than when it was when I was buying the place. But they're going to take a look. What are the trends for what you're selling or what you're producing in the area that you're selling it? What is the preparation that I know if you're on the hook for 5 years of repaying this thing, then in 5 years, what's my guarantee that your business is going to be as strong then as it is today? So all those little details of research help out. And as a business advisor, every day I'm doing comparative analysis that a company is doing this. I go and research who else is doing that, what's their trend line. All of this is meant to help guide you as a business, but it's also meant to provide that level of comfort to a loan officer about the amount of risk on the money. Again, you can get your own credit reports. All the major credit companies, if you don't know your personal credit score, highly suggest that you know it. If you're below 600, you're considered to be at higher risk than above 600. There are companies out there that do credit counseling. Business impact is not one of those. Um, Credit repair is a big thing in these days, but know what your credit report is, know what the red flags are. Once again, it's you going out there asking for money that you don't have. And so the risk for someone else to give you that money, all of these things combine. Uh, Again, when to apply, the sooner the better, because the outstanding factors, how much do we need? What's the state of the economy? How many individuals and or institutions will lend to an organization like ours? What would be the time to fund? Um, all of these things take time, and time is the most precious resource we always have. If you have a payment coming up, I have another client has a brand that's been around since 1927. The other week, she's like, I need 50 grand to pay for a supply coming out of China. I need these things on a boat moving because it's going to take them 60 days to reach shore where I actually receive money for them. So we need a float for 50 grand to get the inventory on the water. We were able to handle that because we had already prepared all the details of the business. We had everything ready that that particular lender could take a look at and say, okay, I understand, given your track record, given your history, you're not going to be a risk at this thing. So we actually did a 12-month working line of credit specifically for that inventory. So the sooner that we get started, the sooner we get prepared, the sooner we'll find out how long might it take us. And if it's we need to go to 5, 6, 7, 50 different resources, that's a time slog in and of itself. So the sooner that you can talk to your bank, talk to me, talk to someone else, the better it is. So again, with business impact, we have capital readiness services. Um, it's the complexity is not there. I know a lot of entrepreneurs that always get fluttery about two things. Most hate the word having to do sales. The second one is having to go out and get money, which is ironic because they're both the same thing, right? You got to do sales to get money, whether you're selling yourself to go get the loan product or you're selling goods and material. Again, the best leverage an entrepreneur can have is options. The best option you could have is strong cash flow. You've probably heard this before. Cash flow is king. If you have strong cash flow that demonstrates customers, demonstrates profitability, demonstrates you can execute on your business, you can go to a lot of sources for money. And that's your best leverage is I don't need this. When you don't have those things, you have less leverage, fewer options, which then it increases the time, increases the amount of interest you're going to have to pay on that capital because you're a higher risk factor. So when you work with an advisor or someone, always imagine yourself in front of them. How do they see you as a risk? The more you know about your business, the more prepared you're at, the better the track record. If your business is going strong, once again, if you're in a startup, what's going to make you successful? What's going to decrease the risk on the money? If it's an equity investor at that point in time, what's the likelihood in 2 years if you're successful, you will either buy them out, meaning you'll pay them for their equity stake at the value that the time you're going to buy it from them, or are you building your thing to be sold to someone else? If so, who would want to buy your company for whatever it does? Silicon Valley has headlines every day. This company's buying this company. Microsoft, Lord knows, has bought how many startups. But for every one of those that's announced, there are dozens that didn't quite make it. Different market factors, different execution. The whole role of a business impact advisor is to give you the best shot in the shortest period of time to get what you need, mainly because your business success is our success. And being around since 97, we've been through the ups and downs of the economy. I can tell you the past year and a half has been very rough for a variety of reasons, navigating through the waters. the cash flow of a business is the lifeblood. And if you're not generating cash flow and you need capital, it's going to be a difficult way to go. But there are products out there from various people and institutions that could do it. So whoever you can go to and ask for advice, I would definitely suggest that happens. The Economic Alliance, again, a great place to start because there might be other local sources. Earlier in this session, I mentioned that there are grants out there. There are thousands of grants. There's federal grants, there's state grants, there's local grants, there's individual grants, grants for women, grants for veterans, grants for natives. There's a wide variety out there. Some might be $500, some might be 5,000, some might be 50,000. When we're out raising money, I suggest to my clients, look, we're going to spend X amount of time every week always mining for money. Now, every week we're sending out for grants, right? We're filing for it because the likelihood that we'll get it is not astronomically high. So it's a numbers game. If we're going out for financing and funding, how many bankers are we hitting up? How many other folks are we hitting up? It's just a numbers game because all you need is one or two. And then once you actually get a loan and repay a loan, your ability to get another loan goes up because now your risk factor is less. In Silicon Valley, it's well known. You don't make a lot of money selling your first startup normally. What that means is that you understand how the game works. So the next startup you do, more people are likely to invest into equity because they know that you understand how to take capital, grow it, and return it. So just some basics within it. Again, we have on our website a rich library, whether it's specifically for women-owned businesses, for farms, whether you want to learn about social media and how to promote your business that way. If you want to learn, again, how to do PL sheets, anything else, more likely than not, we have past sessions that have been recorded or we have upcoming classes that are going on. Today, if you feel prepared, again, if you want to start going down the loan path with business impact, with my clients, I suggest let's get the process started so that we get on the calendar of the loan officer and we work to prepare all the materials that we know are going to be needed. But it starts the process. 99% a lot of this stuff is just getting started and going through it and starting to get the feedback. Within the closed loop of business impact, I have loan officers that reach out to me and say, Adam, about this client that you applied for, have you gone through these things with them? So it's a more friendly confines, if you will. But you can go to your local bank. Again, if you have a relationship already with a financial institution, that's always a great starting point. They might be a financial institution, say, look, you need to go talk to a CDFI. We're not the only CDFI in town. My role as an advisor is to help my clients achieve success. And if we're not going to be the best product for you, we'll guide you to whomever might have that product for you. If I think our rate is going to be 2 to 3 points above someone else's rate, I'll guide you towards them. Why? Because it's your business, it's your cash flow, every penny counts. But you can get further faster through a lot of self-help things. Again, our website is great, but for my clients, I often send them links to YouTube. As I said, that's my cheat. And there are great people offering great hints and tips. If you want tips on how to do a pitch deck, if you want tips on how to do anything else, guaranteed YouTube has a plethora, a veritable cornucopia, as I say, of information available out there. So that is the basic overview of financial literacy. Um, Happy to go on ad infinitum if we have interactivity at this point in time. Mason, this is your song and dance. If there's more questions from the Economic Alliance or anyone on board, more than happy to engage. If you want to access business advisory services on the Business Impact main webpage, there's a place to sign up for free business coaching. So you can go in and do that. Do we have some questions or were people just saying goodbye?
It's a good question from Yuri about rentals. Are you referring to like rent commercial properties for lease in the area?
Homes.
So
Home.
you have homes that you're looking to rent. You're looking to buy homes to use as rental properties.
They're paid off, and I have one that I want to put to rent, but I just don't know how to manage it, more like the paperwork. So when I do report it to the taxes, and all that stuff.
Okay. So specifically with property rentals, the first question becomes is um, well, it's to understand who's going to rent out the property, what is going to be your duration, your term. Um, and then second, are you going to be the manager of the property or are you going to have a property management company? Property management companies tend to take care of finding renters. They make sure that the property is in order. If the renter has an issue, they call the property management company, and the property management company, of course, takes a percentage of the monthly rent under contract to pay for their services. If you're doing it by yourself,
I want
um,
to try doing it by myself.
if you're doing it by yourself, then I would suggest you're also, well, once again, I would suggest going out to YouTube and putting in the inquiry, I want to rent my own property, and people will walk you through the checklist as far as what you're going to need to do. So that'd be first and foremost to get you up to speed. Second, you're probably going to need um, a lawyer for at some point in time just to review your legal documentation that a renter is going to have to sign, as well as you're going to have to run a background check on renters, which is include credit check, criminal history, all of these things. And so that means once again you're probably going to have to employ some sort of legal assistance to go through it because anything you're going to have a renter sign, you're going to make sure that it's a legally binding document in the state of Washington, and particularly in your location, your county, et cetera. And what that rental document will describe is 8 pages of terms and conditions. Um, because then, as you'll find out on YouTube, and I know this specifically because I went through this with a client a few months back, make sure that you have detailed documentation of the state of your property as it's currently in, that you have photographic or video documentation of everything. Because in the rental agreement, they will sign off and you will collect security deposits and everything else. Um, and then also it will have a clause and term in your rental contract, what happens in case of default on payments. So
Okay.
um, all of those things, again, it's publicly available information. If you wanted to have a session with me to go through it, not a huge issue, but I would just go to YouTube, get yourself educated more on what it is. Uh, and then as we dial it in, to me, the main thing is what is your financial expectation from the property? But the other thing the YouTube video will walk through with you is how you keep track of all your expenses because now this is its own tax write-off entity. Um, so if you haven't formed your own business, most people I know of that do multiple rental properties, they have an LLC that they establish specifically for that. Um, if you're just renting out your house as a sole property and you're a sole proprietor, you can do that, but just understand if you're not using a property management company, what your liabilities are. And
Okay.
for better or for worse, and again, you'll have to go and check with your insurance company. There is specific, you have to have specific renters insurance packages and property insurance for that. Uh, yep, just a bunch of details. But again, I went through this a couple months ago with a client, and it's if you ping out at me, I'll send you the YouTube links, but it shouldn't be that hard to find. Then once you have all those things compiled, then if you want some guidance and some help, we can walk you through it. I don't know, if the Economic Alliance has, available legal counsel for these type of documentation reviews. UW, I think, has an entrepreneurship center. Down here in Oregon, Lewis and Clark has some pro bono legal counsel just to put eyes on things. So there may be ways for you to have access to professionals that will either help you out pro bono at no charge or at minimal charge.
Okay, perfect. Thank you so much.
No problem. Okay, well, I seemingly cleared the board here and finished in my compact time.
Yeah, well, since we've got a little bit of extra time left over, Adam, before we wrap up, I was just going to see if you'd be willing to go into just a bit more detail about the different financial statements, balance sheet versus cash flow versus profit and loss, like the key relationships they show, and what a lender might be looking for on those.
So as I said, with Business Impact, we have standard forecasting tools that we use. You had asked about startup companies and how you forecast things out. We have a financial workbook, and I'll just do a quick run through here. Again, we have links on the website that walk through these things. Um, but I will share this one. When it comes into balance sheets, PLs, uh, so let me do this here. Don't share. Okay, so I'm going to start off with our financial workbook. Um, and I'm just going to go over it briefly. Again, I do this with clients every day. So our workbooks, if you're not familiar with spreadsheets, we walk through it with you and try to make it as simple as possible. If you are familiar with spreadsheets, it's not really complex. The big thing to understand with our spreadsheets is twofold. Number one, we try to color code it. So if there's a part in green, it means that we can put a number into it. If the part is in gray, that means that we're automatically doing stuff in the background, carrying things over, doing calculations. Our financial workbook spreadsheet, this is for startup businesses, existing businesses. It's just trying to show that you need money for something. So at the bottom of the spreadsheet, we have multiple tabs. So on a spreadsheet, you have tab after tab after tab for different sections. The first tab within our financial workbook is our project or startup costs, meaning do we know how much money we need and what's it going to be on? Again, a spreadsheet, if there's a term in there that doesn't apply to us, we can replace it. Some of these things don't matter to some businesses. If we're looking to buy buildings or real estate, we have a section for that. If we're looking for leasehold improvements, we want to change the walls, et cetera, we have a section for that. Capital equipment. Again, my client buying a tow truck. We have prepaid rent, perhaps. We have prepaid salaries. We have insurance. What do we need money for that when a financial officer looks at this spreadsheet, this workbook, they can go and immediately see, okay, I see here that you require working capital, equipment capital, these type of things. So at a glance, they immediately know how much you need. Then the second tab that we have, and this becomes kind of the voodoo wizardry, that if you already have an established business, you already know what your sales are going to be. But for us, we're saying, okay, how are you going to generate money? So we have sections to say what it is that you're selling. It could be a product, it could be a service. And we want to know in a given month, how many units of that are you planning on selling? Are you planning on selling 100 candles? Are you planning on selling 100 hours worth of consulting? What is the price that you're charging for that particular object or unit? Then we calculate for all this stuff, what is going to be your monthly sales? Again, if you already have track record going into it, it makes it easier to estimate, but you could break it down by products, categories, etc. But very basically, this says how much money do you expect to make on a monthly basis? The next tab we have goes through what we call cost of goods. Now, if you're running a service, normally you don't have a cost of goods. A cost of goods is if I'm selling a can of beans for $10 and I buy it for $1, my cost of goods is $1 because it's directly related to that one product that I'm selling. That has nothing to do with my monthly expenditures for my business. That's a different thing. A cost of goods is what is the raw material I need to do to be able to sell this at the price I want to sell it for. The reason why we do that is when you take your gross revenue and you subtract your cost of goods, that gives you what's considered gross profit, right? Are you making more money than you're spending on those particular items? On our spreadsheet, then we have a section for actual payroll. Now, within certain companies, there are two types of people that we pay. If it's payroll, that means we're getting a W-2, which means we're paying state taxes, local taxes, etc. The reason why we have a separate payroll sheet here is we automatically calculate what those taxes are that come out of it. This is called a burden rate. So if I hire someone, I'm saying I'm paying you $100. Once I, as a company, pay my taxes, etc., I'm more likely paying $120. But we want to know how many people are on payroll. If they're not on payroll and they're just a contractor, then that's a separate section, because now we come into our next sheet, which is projected profit and loss. And this is where, once again, our sheet carries over what exactly are our sales going to be, our gross revenue, total sales, what are our cost of goods for those materials, gives us line 25 gross profit. But now under this sheet, what we want to know is, do you know all of those expenses that go into your business on a monthly basis? So this could include advertising, insurance, rent. It could include paying for the website. It could include the interest expenses. It could include professional fees. Again, if someone's not on payroll, meaning an employee, but they do odd jobs and I pay them $20 an hour, I put that into this. The reason why we do that is when we take our gross revenues, we subtract our cost of goods to give us gross profit. Now we have to take all of our monthly expenses and subtract that from the gross profit, which gives us line 61, our net profit. On any financial spreadsheet, if a number is in red or it has parentheses around it, that means a loss. And so at a snapshot here, we can see, do you know what it takes to run your business on a monthly basis? And when we take your sales forecast and we subtract these things, are you projecting to run at a profit or a loss? Now, because the purpose of this call is financial literacy, the other thing our spreadsheet does is we actually have sections for the balance sheet. But more importantly, we have sections for financing, because as I, as an advisor, work through with an entrepreneur, I'm like, how much money do we need? And if we're going to get it financed, what's going to be the term of the loan? What's going to be the interest rate, etc.? Because on projected profit and loss, we showed when we subtracted things, were we making money at the end of the month? But the one thing it didn't take into consideration, because that's part of cash flow, is what if we are repaying the capital on the loan? So we have a cash flow sheet that shows every month what's my cash position at the beginning of the month. And when I subtract everything, including my repayment of principal on my loan, then what's my cash on hand at the end of the period? Because in any financial scenario, I start off the month with a certain amount of money in the bank. At the end of the month, do I have more money than that, or do I have less money than that? And if the trend line keeps showing every month I have less and less and less money, eventually I run out of money. So we as advisors use this sheet to go through an entrepreneur, take a look and say, number one, do we know the factors that drive the business? But more importantly, do we understand how long will our cash last given our assumptions, right? So cash flow within any business, it's understanding where all your pennies are at and how to save a penny, how to grow a penny, whatever it is. This lends into our balance sheet saying for the business, what are your assets, everything that you own, including cash in the bank, versus liabilities, everything that you're paying back on or that you don't own outright. And on a PL means at the end of it, are you making money or are you losing money? And a PL basically is what's your revenue, what are all your expenses, and what does that show? And most times a PL could be on a monthly basis, a quarterly basis, an annual basis, depending on what you want to do. But from a spreadsheet activity, I tell a lot of my clients we should know, if we can know, we should know every day what's the status of my bank account. My client that I mentioned that's been around since 1927, every day, every day she sends me a snapshot. What's in the bank account? What's on accounts payable? What's on accounts receivable? What's on my line of credit? Why? Because I have to instill the discipline of that's the lifeblood of the business. Every morning we have to know those to protect ourselves against one day waking up saying, "Oh crap! I thought I had an extra 10 grand in the bank account. What happened to it?" That's the difference between making payroll and not. So, Mason, hopefully that kind of helps walk through the process. But again, that's where having an available free resource like Business Impact, it does help. And I've had clients that I've started this worksheet off going out and getting financing, and now they use it as a day-to-day tool for their business. Because every time they pick up a new expense, they add that category to know how is that going to impact me next month on my cash flow, so that I know one way or the other, am I going to have money to pay for rent or not?
Yeah, excellent. Yeah, I appreciate the use of those visuals, Adam. I think that added a lot of clarity to the things we were discussing. So, with that, if there are no further questions from the audience here, I suppose we can go ahead and wrap things up a little bit early. Um, oh, it looks like we got one from Tashina. Go ahead.
I thought I would ask over video just because it'd be easier to explain. Back on the P&L, would say like a cannabis tax, would that go on a P&L or is that more like a liability on a balance sheet?
No, that's PL because, well, estimated taxes normally don't hit a PL statement. When I ran my restaurant, I had said I had a liquor tax, right? And where I was at, the liquor tax was actually higher than the income tax. And in theory, we were also always supposed to keep that liquor tax in a separate account, so we always paid the liquor tax. But when you're light on payroll, you dip into it. It's good to know where it's at. Once again, if it's a cannabis business, we're not able to go out to traditional banks for financing because it's still a federal ban. That's why cannabis business is a cash only basis. So that in and of itself, it's keeping your balance sheet for a cannabis business is more of number one, so that you know what's coming due, meaning I know I have this much in taxes I have to pay. If you're an LLC running a cannabis business in the state of Washington, like any LLC in Washington, I don't have to do quarterly reporting unless I'm making, I think, over $325,000 a year. So if you're making less than that, you're just reporting at the end of the year. I don't actually know Washington Department of Revenue what the frequency payment is on the cannabis tax, but that is within your cash flow statement, always knowing I have this outstanding liability that has to be accounted for. For most smaller businesses, paying attention to a cash flow statement is it normally doesn't roll up to a PL, but if you're using a QuickBooks or a product like that, it will automatically translate your cash flow into a PL. And so when you're inputting the numbers, it will automatically have that category for taxes owed. But then it becomes, when are you supposed to pay those taxes? From personal experience, it's always better to pay taxes when you got the money than say, oh crap, I spent the money and now I've got no money for taxes, because departments of revenue typically don't like that scenario. But again, I'll tell you the cheat, and even though I've been in business a long time, as you can tell from my aerodynamic gray format here, these days, whenever I have a client in Washington, I go into Gemini, which is my AI engine of choice, and I say, I have a client that's doing this type of business. I want to know for the state of Washington, for this county, this city, where are all the licenses that they require? What's the frequency of payment on those licenses? What are the taxes that they need to collect? what are the boundaries around those taxes? And so I ask I ask the internet to tell me what are all those specific things because it's that frequency of payment, right, on the collection. And especially when you're dealing with a cash basis, and I actually never thought through that with a cash basis. How do I pay Department of Revenue my taxation tithe? But I'm certain it's being done every day. So with those specific questions, I would kind of go in to that formula. If you need more specific help, once again, I'll put in the chat my email at Business Impact. Anyone can hit me up at any time for any questions because I love getting smarter. And every time I don't know something, I have the opportunity to get smarter, which means I got a lot of opportunities each and every day. So yeah, if you can't find the information that you need, hit me up on that. All right. Well, I appreciate everyone joining today. Again, reach out to me with specifics, and at this stage, anything I can do to help any business get further faster, that's what I wake up in the morning for.
Absolutely. Yeah. Thank you everyone for joining. Thank you, Adam, for leading this excellent training here. As I said, this session has been recorded, so it'll be available for repeat viewing if you want to go back and review anything. That's going to be on the Economic Alliance YouTube channel within a couple of weeks. And yeah, as Adam mentioned, reach out to him with further questions or ideas. Reach out to us here at the Economic Alliance. We're both here and around to help out.
Thank you, Mason.
Thank you, Adam. Thanks, everyone. Have a good rest of your day.